Here is a completely original, institutional-grade market analysis script. It utilizes the exact same publicly available macroeconomic data, technical levels, and news events from this week, but builds an entirely fresh analytical framework with an authoritative, elite financial tone designed to captivate your audience. The weekly macro masterclass, Bitcoin's Structural Resilience. Part 1. The Executive Summary and the Ultimate Bullish Divergence. Good Saturday morning, everyone. We are looking at Bitcoin trading right around $79,049 this morning, hovering just beneath that crucial $80,000 threshold. Today, we need to step back from the minute-by-minute charts and conduct a comprehensive, institutional-grade forensic breakdown of what transpired over the last 120 hours. Because when financial historians look back at this market cycle, this past week will be highlighted as one of the most defining, complex, and revealing stress tests Bitcoin has ever endured. Let us evaluate the sheer whiplash of this week's price action. We initiated the weekly session on Monday near $79,500. By Thursday afternoon, fueled by historic legislative tailwinds surrounding the Clarity Act markup, we surged to $82,000. Yet by Friday evening, an absolute macroeconomic tempest dragged the market down to lows of $78,600 before buyers stepped in to stabilize the asset right back at $79,000. It was a flawless four-day round trip. We witnessed an unstoppable regulatory tailwind collide head-on with an immovable macroeconomic headwind. On paper, Bitcoin ended the week essentially flat, up a modest 0.6% since last Friday. But here is the profound market insight that 99% of retail analysts are completely missing this morning. The true story of this week is not that Bitcoin failed to hold $82,000. The true story is that Bitcoin endured a relentless, multi-front macroeconomic assault and absolutely refused to break down. Consider the sheer gravity of the economic data the market was forced to absorb this week. We faced a scorching producer price inflation print of 6%. We absorbed a consumer price index reading of 3.8%. We watched market-implied odds of a Federal Reserve rate hike surge to nearly 50%. We digested the regulatory disclosure of a potential Bitcoin sale by the world's largest corporate treasury holder. We witnessed a staggering $635 million in a single day of spot ETF outflows. And we saw global crude oil cross the ominous threshold of $100 a barrel amidst escalating geopolitical friction. In any previous market cycle, that specific confluence of catastrophic macro events would have triggered a violent 20 to 30% liquidation cascade. The fact that Bitcoin absorbed that historic barrage of sell pressure and is still peacefully resting at $79,000 this Saturday morning demonstrates an extraordinary, impenetrable structural bid underpinning this asset class. Today, I am going to deconstruct exactly how the market structure absorbed this shock, what the institutional on-chain data is revealing, and the precise mathematical roadmap Bitcoin must navigate next week to break free from this macro consolidation. Let us dive in. Part 2, the macroeconomic battlefield, a day-by-day deconstruction. To truly comprehend the current market psychology, you must understand the exact chronological sequence of events that unfolded this week. Markets do not operate in a vacuum. They operate on shifting expectations. On Monday, Bitcoin opened in a highly constructive posture at $79,490. Capital was deploying systematically, front-running the anticipated Thursday markup of the landmark Clarity Act. The institutional trading desks were positioning for a breakout. Then came Tuesday morning, and the macro narrative fractured. The consumer price index printed at 3.8% year over year, the hottest annualized inflation figure the United States has recorded since September of 2023. In an instant, the entire Wall Street consensus was inverted. The prevailing debate among macroeconomic strategists shifted from how many rate cuts will the Federal Reserve execute this year to is the Federal Reserve going to be forced to resume rate hikes? Wednesday compounded the bearish momentum. The producer price index, the leading indicator for future consumer inflation, surged to 6% annually, marking the highest wholesale inflation print in over a year. Simultaneously, international peace negotiations surrounding the Iranian conflict stalled, sending West Texas Intermediate crude oil ripping past $100 per barrel. Higher oil prices guarantee stickier headline inflation, effectively tying the Federal Reserve's hands. Yet on Thursday, the crypto ecosystem demonstrated its growing decoupling potential. Despite the bleeding macro environment, the Senate Banking Committee officially voted to advance the Clarity Act. This historic legislative milestone sent an electric shockwave through the industry. Bitcoin rapidly detached from the falling S&P 500 and squeezed aggressively to $82,000, its highest valuation since January. The broader digital asset equity sector caught fire. Coinbase and Circle witnessed massive institutional volume spikes, leading the entire financial sector higher for a glorious 6-hour window. But markets are ruthless, and Friday delivered a brutal reality check. The macroeconomic gravity finally caught up to the regulatory euphoria. As bond traders panicked over the inflation data, the 10-year U.S. Treasury yield spiked to a multi-year high of 4.58%. The CME FedWatch tool, which tracks institutional rate expectations, priced in a near 50% probability of a 25 basis point rate hike by December. This yield spike triggered an immediate risk-off rotation across global markets. Spot Bitcoin ETFs experienced $635 million in net outflows, the single largest institutional drawdown day since mid-November of 2025. Bitcoin was shoved from $82,000 down to $78,600 in a matter of hours before institutional limit orders absorbed the panic and brought us back to $79,000. That is the anatomy of the week. A tug-of-war between structural crypto adoption and macroeconomic tightening. Part 3. Technical architecture and the golden cross phenomenon. Let us turn our attention to the charts, because amidst the cacophony of macroeconomic headlines, a monumental technical milestone was achieved this week, one that is being criminally ignored by short-term commentators. A confirmed golden cross has materialized on the Bitcoin daily chart. Specifically, the 50-day simple moving average has decisively crossed above the 100-day simple moving average for the first time in months. In the realm of technical analysis, a golden cross is widely recognized as one of the most reliable, high-probability bullish continuation signals available. Mathematically, it proves that short-term market momentum has become significantly more powerful than the medium-term structural trend. To understand the weight of this signal, we must look at recent market history. The last time this precise 5100 golden cross formed on the daily chart within a similarly restrictive macroeconomic climate was in mid-2023. At that exact moment, Bitcoin was consolidating quietly around $27,000. Within 6 months of that technical crossover, the asset was testing $45,000. While historical performance does not guarantee future magnitude, the mechanics of the signal remain valid. A moving average crossover of this scale is a lagging structural development. It is not easily invalidated by one volatile Friday session or a temporary spike in Treasury yields. It represents a fundamental shift in the underlying current of the market, signaling that medium-term institutional accumulators have seized control from the bears. Furthermore, when we analyze the broader technical landscape, the levels dictate a very clear mathematical roadmap for both the bulls and the bears. Right now, the ultimate overhead resistance is sitting at exactly $83,300, which represents the 200-day simple moving average. This level sits just above the 200-day exponential moving average, located at $82,228. If Bitcoin can secure a confirmed daily close above $83,300, the technical ceiling vanishes. The chart immediately opens up to $85,000, which aligns perfectly with the 38.2% Fibonacci retracement level measured from the macro peak of $126,000 down to the cycle low of $60,000. Clearing $85,000 sets the stage for a march toward the 50% Fibonacci retracement at $94,000, ultimately leading to a retest of the legendary $100,000 psychological barrier. That is your definitive upside architecture: 83.3, 85, 94, and 100,000. Conversely, as professional market participants, we must maintain equal clarity on our downside defensive structures. If the macro environment continues to deteriorate, our primary structural line in the sand is $76,000. This level represents the 23.6% Fibonacci retracement and serves as the exact midpoint of the macro ascending channel that has governed Bitcoin's price action since February. Should 76,000 give way on a daily closing basis, the next layer of institutional support is the 50-day simple moving average resting at $73,000, followed by the absolute bottom of the ascending channel at $71,000. Do not allow emotional bias to blind you to either scenario. Memorize these levels. The chart is speaking clearly. Our only responsibility is to listen. Part 4. Institutional paradigm shift and corporate dynamics. Now, let us address the corporate treasury developments that generated immense debate across financial media this week, specifically the regulatory disclosures from MicroStrategy. We need to strip away the sensationalism and examine the cold, hard balance sheet mechanics. On Friday, MicroStrategy filed documentation with the SEC indicating potential Bitcoin sales to facilitate a $1.5 billion convertible note buyback, structured at an advantageous discount of approximately 92 cents on the dollar. Predictably, retail sentiment plunged into hysteria. Polymarket betting odds predicting that MicroStrategy would sell a portion of its Bitcoin treasury before December 31st skyrocketed from 12% to 94% overnight. The prevailing social media narrative immediately proclaimed that Michael Saylor's never sell philosophy had fractured. But let us examine the comprehensive financial reality. MicroStrategy currently holds 818,869 Bitcoin at an average cost basis of $75,537. At today's valuation of $79,000, the corporation is sitting on approximately $3.1 billion in unrealized profit. Even if the Treasury management team executes a minor strategic liquidation to fund this discounted debt retirement, Michael Saylor's stated corporate doctrine remains intact. Sell one to acquire 10 to 20 more. According to recent projections published by JP Morgan's equity research desk, MicroStrategy is positioned to deploy up to $30 billion in capital to acquire additional Bitcoin throughout 2026. A debt restructuring allocation of $1.38 billion represents less than 5% of their projected annual purchasing power. The company is actively executing a sophisticated corporate finance maneuver, retiring expensive convertible debt at a discount, optimizing their capital structure, and reinforcing their long-term balance sheet stability. The narrative that MicroStrategy is capitulating is a comforting fiction for market bears, but it is entirely disconnected from the mathematical reality of their treasury strategy. However, from a pure market flow perspective, we must acknowledge that this disclosure introduces a new variable. Corporate treasury acquisition velocity experienced an 80% deceleration in May compared to the aggressive purchasing metrics recorded throughout April. When corporate buying pauses at the exact same moment that institutional ETF flows turn negative, as we witnessed on Friday, the structural floor supporting the asset temporarily thins out. This explains why Bitcoin ended the week flat, despite the monumental passage of the Clarity Act. The institutional demand vacuum allowed macro headwinds to neutralize regulatory tailwinds. Yet, while retail traders were panicking over corporate debt filings, an infinitely more important institutional milestone occurred this week, one that represents a profound structural evolution for Bitcoin as a global reserve asset. Dartmouth College, one of the elite 8 Ivy League universities in the United States, officially disclosed a $14.5 million allocation to spot Bitcoin and Ethereum ETFs within its permanent endowment. To appreciate the gravity of this allocation, you must understand how university endowments operate. Endowments like Harvard, Yale, Princeton, and Dartmouth are the most conservative, highly scrutinized, and risk-averse capital allocators on the planet. They operate with centuries-old legacies, managing capital under the strict oversight of multi-layered investment committees, rigorous fiduciary compliance teams, and sensitive donor relations boards. When Dartmouth College allocates capital to a spot Bitcoin ETF, it is not a speculative trade. It is the result of an exhaustive, multi-year due diligence process wherein the highest levels of academic and financial leadership concluded that Bitcoin possesses a permanent, institutional-grade risk-reward profile suitable for a perpetual wealth fund. Endowment capital is the ultimate definition of sticky money. They operate on decades-long investment horizons. They do not panic sell because the 10-year Treasury yield ticked up on a Friday afternoon. Furthermore, institutional asset management operates on peer validation. Now that Dartmouth has crossed the regulatory and reputational Rubicon, other major endowments will inevitably follow suit. This establishes a permanent, price-insensitive institutional foundation under Bitcoin that simply did not exist in any previous market cycle. This institutional preference was further solidified on Thursday when JP Morgan's quantitative research team, led by Nikolaos Panagurtsoglou, published a formal research note officially designating Bitcoin as the clear institutional asset of choice over Ethereum and the broader altcoin market. The analysts emphasize Bitcoin's superior structural market depth, its rapid recovery velocity in ETF flows, and its dominant positioning within CME futures markets. When a financial titan like JP Morgan publishes an explicit endorsement of Bitcoin dominance to its institutional client base, it directly influences the allocation strategies of Morgan Stanley's $9.3 trillion in wealth management assets and family offices globally. This is precisely why Bitcoin dominance remains firmly entrenched above 60%. The smart money is not rotating into speculative altcoins. Institutional capital is aggressively consolidating within the apex asset. Part 5. On-chain metrics and the new whale psychology. To corroborate this institutional thesis, we must examine the blockchain itself. The on-chain data currently provides a fascinating look into the psychology of the market's newest major participants. According to data compiled by AliCharts, the realized price, or average cost basis, of new whales, defined as institutional entities that have accumulated massive Bitcoin positions within the last 155 days, is currently sitting at exactly $80,300. With Bitcoin trading at $79,000 this morning, this entire cohort of institutional accumulators is currently sitting slightly underwater. In market psychology, whenever a major holder class is pushed into an unrealized loss position, their subsequent behavior becomes entirely binary. They either suffer a crisis of conviction and capitulate, triggering a cascading sell-off, or they demonstrate ironclad conviction, absorbing the volatility because they understand the macro thesis. The fact that Bitcoin was pushed below the new whale cost basis of $80,300 multiple times this week, yet completely refused to break down below $78,600, provides undeniable proof of institutional conviction. These entities deployed billions of dollars in the $65,000 to $85,000 range. When the market dropped on Friday, they did not rush for the exits. They stood firm and absorbed the retail panic. This confirms that the floating supply of Bitcoin is currently held by resilient, well-capitalized institutions with multi-year time horizons, not over-leveraged retail speculators vulnerable to liquidation wicks. Part 6. The Catalyst Matrix. What to watch next week. As we look ahead to next week, we are entering a highly dense, critical catalyst window. To navigate this environment successfully, you must implement a structured, event-driven framework. There are 4 primary macroeconomic and regulatory triggers that will dictate Bitcoin's trajectory over the next 7 days. The first, and undeniably most significant catalyst, is the inaugural public appearance of Kevin Warsh, who officially assumed the mantle of Federal Reserve Chair as of yesterday, May 15th. His initial public address next week represents the single most vital macro event for risk assets between now and the June FOMC meeting. The global financial markets will dissect every syllable he utters regarding monetary policy. If Chair Warsh adopts a measured, neutral to dovish tone, hinting that the Fed remains open to rate stabilization despite recent inflation prints, the market-implied 50% probability of a rate hike will instantly collapse. The US dollar index will drop, Treasury yields will retreat, and Bitcoin will receive the macro tailwind required to slice through $83,000. Conversely, if his inaugural rhetoric is aggressively hawkish, rate hike probabilities will harden, the dollar will surge, and we will immediately test our $76,000 structural support. The second critical catalyst to monitor is the velocity of spot Bitcoin ETF flows. While Friday's $635 million outflow was jarring, institutional flow data must be analyzed on a rolling cumulative basis. The primary metric to watch is the Monday and Tuesday morning flow reports. If we witness an immediate resumption of net inflows, even a modest $100 to $200 million across the issuers, it will confirm that Friday was merely a localized, yield-driven profit-taking event. However, if consecutive multi-hundred million dollar outflows persist into Tuesday, it will indicate a deeper institutional de-risking cycle, increasing the probability of a drawdown to our lower support bands. The third catalyst is the geopolitical energy complex, specifically West Texas Intermediate crude oil. Oil closed the Friday session above $100 a barrel, following stalled ceasefire negotiations and assertive diplomatic statements from the U.S. administration regarding the Iranian conflict. If diplomatic channels produce any semblance of de-escalation over the weekend, crude oil will pull back sharply, instantly relieving global inflation anxiety and providing a massive boost to risk assets. If geopolitical tensions escalate further over the weekend, crude oil will cement its position above $100, guaranteeing a scorching May CPI print and keeping the threat of a Fed rate hike squarely on the table. The fourth catalyst is the official legislative scheduling of the Clarity Act for a full Senate floor vote. Following Thursday's triumphant committee markup, the power now rests with Senate Majority Leader John Thune, who controls the legislative calendar. The critical operational question is whether the bill is scheduled for a floor vote prior to the impending May 21st Memorial Day congressional recess. If the bill is fast-tracked and scheduled before May 21st, the regulatory premium assigned to crypto assets will expand exponentially, creating an immediate magnetic pull toward $85,000. If the vote is delayed until after the recess, the regulatory tailwind will temporarily dissipate, forcing the market to rely entirely on macro conditions throughout late May. Furthermore, we must keep a watchful eye on a looming macro wildcard, the United States debt ceiling. The U.S. Treasury is currently actively deploying extraordinary accounting measures to prevent a sovereign default. According to the Congressional Budget Office, these emergency liquidity buffers are projected to exhaust between July and September. While this is not an immediate operational risk for next week, historical precedent proves that the severe bond market volatility and liquidity constriction that precede debt ceiling showdowns often trigger sharp, risk-off reactions across risk assets. We must integrate this looming liquidity event into our Q3 risk management frameworks. Part 7. Strategic Execution Framework and Closing Thoughts. Understanding macroeconomics and charting technicals is useless without a disciplined, systematic execution plan. Let me share the exact objective framework governing my personal capital deployment going into next week. Throughout this entire week of extreme volatility, I maintained strict operational discipline, holding exactly 1/3 of my allocated Bitcoin position size. I explicitly refrained from adding to my spot position because my mandatory confirmation signal, a confirmed daily candle close above the 200-day exponential moving average at $82,200, was never achieved. That strict adherence to rules-based trading protected my capital from Friday's macro-induced drawdown. Moving into next week, my capital deployment is governed by 4 specific conditional triggers. I do not trade on emotion, social media sentiment, or hope. I execute solely when the market provides mathematical confirmation. Trigger number 1. If Fed Chair Warsh delivers a neutral to dovish inaugural statement and Bitcoin successfully reclaims the $80,000 level on a confirmed daily close by Wednesday, I will systematically deploy 15% of my remaining capital allocation. Trigger number 2. If institutional spot ETF flows flip back to net positive on Monday and Tuesday, accompanied by WTI crude oil retreating below $95 per barrel, I will allocate an additional 10% of my capital. Trigger number 3. If official confirmation crosses the wire that the Clarity Act has been formally scheduled for a full Senate floor vote prior to the May 21st recess, I will deploy another 10%. Trigger number 4. If Bitcoin demonstrates ultimate structural strength by breaking and closing decisively above the 200-day simple moving average at $83,300, I will deploy the final remaining tranche of capital, returning my portfolio to a maximum position size. Each tranche of capital is deployed incrementally, strictly validating the market's strength step by step. However, as professional risk managers, we must maintain an absolute commitment to capital preservation if the market invalidates our thesis. If the incoming data flips bearish, if Chair Warsh is aggressively hawkish, if ETF outflows compound for a second consecutive week, if crude oil entrenches itself above $100, and if Bitcoin suffers a confirmed daily close below our $76,000 structural support, I will immediately slash my existing 1/3 position down to 1/5. I will preserve my liquidity and patiently await a potential capitulation wick into the $73,000 to $75,000 institutional accumulation zone. The hallmark of an elite market participant is the willingness to instantly update your bias when the empirical data demands it. To conclude our session today, I want to leave you with a foundational perspective on market cycles. This week was widely anticipated to be the most euphoric, bullish week of the calendar year. We had the Clarity Act Clearing Committee, a crypto-sympathetic Federal Reserve chair taking office, and major equity indices touching all-time highs. Yet Bitcoin closed the week completely flat. Does this mean the macro bull market is over? Absolutely not. Does it mean a catastrophic bear market has begun? Not at all. What it truly signifies is that we are navigating a highly sophisticated, institutionally dominated market environment at a monumental macroeconomic inflection point. Both the bullish structural adoption thesis and the bearish macroeconomic tightening thesis are backed by highly compelling empirical data. The upcoming week will serve as the ultimate crucible, determining which of these macro forces will dominate the next 2 quarters. I have provided you with the exact technical levels, the specific institutional flow metrics, the precise calendar catalysts, and an uncompromising rules-based execution framework. Use this data to remove emotion from your decision-making process. Manage your risk rigorously, respect the technical levels, and let the market prove its intentions before you deploy your capital. Have an exceptional weekend, remain disciplined, and I will see you on Monday morning for a complete update on the opening bells. Take care.